Good evening to all. Thanks for logging in for today's webinar. Today's webinar is part of our ongoing initiative to discuss macros, our portfolio, and the outlook for the same. The format for today's webinar would commence with a presentation by Mr. Nitin Raheja, followed by a Q&A round. Please feel free to start asking questions during the session via the Q&A box located below. I now hand it over to Mr. Nitin to start the session.
Hi, good afternoon and good evening to all the participants. It's so good to interact back with you. I think the last interaction we had was in the month of December, and as we got going in January, there were so many things happening. We were in the middle of a results season. We had the budget, so hence this time around we sort of delayed it a little bit. So we said we'll sort of have both events covered. We'll have the results season, behind us, and so also the results of all our companies, and the budget behind us also. So, as we were getting ready to prepare the presentation, one of my colleagues, Varun, pretty much captures the scenario where we are seeing, the COVID and coronavirus yet being the center around which we are seeing markets having done well. And the markets are today very much divided between stock prices which continue to be bullish and keep rallying upwards, and investors who are extremely skeptical and believe that there should be a bear case for the markets rather than the bull case. So I think the cover of our presentation pretty much sums up the mood and the confusion that persists. So we thought we will use this presentation to try and throw some light in terms of how we see the present scenario, where we see are some of the risks, how we are mitigating some of these risks in the portfolio, and and a little bit in the road ahead. So diving quickly into it, I thought we could start off with the bull case as it presents itself today, as far as the economy and the markets are concerned. So the bull case has been that contrary to most expectations, GDP growth has bounced back. So when everybody has learned the various forms of the recovery being K-shaped, U-shaped, V-shaped, and so on and so forth, but nobody really honestly expected the recovery to be so fast and so dramatic. Starting October, the economy has come back with vigor, which has surprised analysts not only in India, but I think all over the world. In fact, all over the world, including people like the IMF and rating agencies, have all gone back and have come out with revised forecasts in lieu of what's the present scenario is. And what is it? After 2 quarters of negative growth, the third quarter is expected to end up having positive growth. And going ahead, the next year, the economy is expected to grow at 11.5%. 11.5% is something which most people hadn't even remotely expected would happen. However, the IMF has now put out 11.5, and the Indian government is talking about more in the region of about 10.5 or 11. But the point is that it's going to be robust. Of course, let's preface it that it is looking that good also because of the low base impact that we will see of the fact that the Q1 was virtually a washout quarter, and there was virtually everything was shut in India. So on that low base impact, we are going to see the next year show up pretty handsomely. And even if you go by the budget numbers, the budget has set a target of almost 14% nominal growth rate. which is including inflation. So, I mean, this is really coming back in some sense in terms of the growth percentage numbers to the heady days, where we were at 7-8% GDP growth plus 7-8% inflation, which was 14-15%. So now we are more like 10-11% of nominal growth and 3%, 3.5% of inflation. So about 14-15% of nominal GDP growth is what's going to happen. Of course, inflation remains a prime concern, mainly due to global supply chains facing demand-supply imbalances from time to time. So although retail inflation has eased, wholesale inflation has jumped. And of course, in the last 2 days, everybody is talking about how the price of petrol has gone up to close to 100 rupees, with one of the regions in Rajasthan actually touching 100 rupees per liter. And so, I mean, that of course remains a very, very key concern as such. However, if you look at high frequency indicators, like I mentioned, they have only been going up. If you see the manufacturing PMI indicator, as you can see, right from August, September, it has moved from 52 all the way to 57. And this is even higher than what it was pre-COVID times. The services PMI, which was the worst hit, because please remember that the services sector virtually shut down, whether you talked about hotels, whether you talked about airlines, whether you talked about tourism, retail, everything has come to virtual zero levels, has, from a level of 5 when it fell, has bounced back, and it is now back and stabilized at 52, 53. Yes, it is nowhere close to the pre-COVID levels of 55, 57. That is because the hospitality sector and the retail sector is not yet back to its previous levels and is yet limping back. But however, the services PMI at this level is yet very healthy. And don't forget that services is also a huge employment generator. And so if services comes back, that means demand and consumption in the economy remains robust. GST collections have surpassed the pre-COVID levels. So, so all these high frequency indicators seem to indicate that the economy is on its way back and is coming back faster than most people's expectation. Other parameters of domestic consumption, you're seeing petroleum product consumption, coming back to pre-COVID levels almost. And this despite the high prices of oil that have happened. Tractor sales have been extremely robust and buoyant, and again back, in fact, almost close to a bit higher than pre-COVID levels. Two-wheeler sales are back to pre-COVID levels. Those intermittent troughs that you see now are more the festival season-led demand, but otherwise, if you see the overall level, they are back to pre. So consumption trends are starting to come back, and once you have the whole tourism industry, and anecdotal evidence would suggest that tourism is also back. In fact, because people are not able to travel outside the country, a lot of traveling is happening within the country. And if you talk to friends, most of them will tell you the scenario in places like Goa and the common hill stations around Mumbai or even around Delhi. I've seen a lot of tourist inflows happen, and this has all been followed with the global institutional investors, voting with their feet for this very, very strong India recovery that has happened, and which has impacted markets, because the kind of inflows that we have seen from the foreigners has been absolutely unprecedented, and they have been at levels far, far higher than what COVID was. And and now increasingly everybody is recognizing that India could be one huge bright spot in the global economy, next only to China. On the COVID scenario, by and large, we have seen the much called about second wave has not been as vicious as was previously thought about. We've seen what has happened in the Americas. We've seen what has happened in Europe. But India and China have somehow managed to flatten the curve. Of course, for Mumbai, the last few days data has not been very encouraging. What with the opening up of the trains, and it was also expected. Even the doubling rate in terms of the infection has is at an all-time high in terms of number of days. So and even the death rate has come down in India. So from a COVID perspective, while I might sort of caution you that we should not get lulled into a sense of complacency or loosen our guards. I think we all have to be very careful. We have to maintain social distancing. We have to keep our masks on. But it does seem that India seems to have the hand of God at work in the way we have, the COVID curve has flattened out as such. By the way, while I talk about this, it is now also being established that the way vaccination in India has happened is setting a case example for a lot of Western countries also in terms of how India has gone about vaccinating and so on and so forth. And then we had the budget. I was very apprehensive with the budget, more so because when the honorable minister talked about a budget once in 100 years, a kind of event. This normally when you set such high expectations, the chances of being disappointed are always far more than the chances of being surprised. But I think the budget, more than its immediate impact, actually set the tone in terms of a very different policy framework for this government and what it has been doing in the last 7 years of its, or 6 years of its existence. Besides the normal, round of expenditure that is talked about in all core infrastructure areas, whether it is urban development, whether it is in, roads, railways, energy, or even the whole, the Atmanirbhar Bharat plan, which includes having PLI schemes for various manufacturing sectors. So these are a lot of these you keep on hearing from time to time, every year in the budget as such. But I think for me, one of the more key salient features, if you ask me, the big ideas, if I were to talk about from the budget perspective, was really, if I have to say this, is that this was a budget which was univocally a pre-growth, a pre-business budget, a pro-business budget, with focus on capex spending to drive growth over the next few years. And why do I say that? I think you could effectively, for the first time, not only from the budget but from the statements that have come from the government and preeminent ministers since then, univocally sort of establish the fact that for the first time they are not afraid to come and talk positively about the role of the private sector in the economy. I mean, the Prime Minister has talked about and even named the public sector and talked about Babu culture, and has talked about how private enterprise should not be looked down upon or punished. To me, so in that sense, this is clearly a sort of a rightist orient budget, where it sort of signals a turn towards the right as far as this government is concerned. We always knew that this is a party with a right-leaning party, but somewhere they were also hiding under a socialist tag over the years. But I think the current crisis has actually made them realize that this is the right way forward, and they are no longer they're no longer hiding under the veneer of socialism, and they've actually come out and talked openly. So what did they do? The major steps. All along, we've had this FRBM Act, which basically forces the government to adhere to a sort of a control on fiscal spending and keeping its fiscal deficit within certain targets over a period of years. And as you can see in the chart below, from a 6.8% level, it has actually come down to almost 3.2, 3.4%. Last year, the government sort of decided to sort of maintain status quo, but COVID then forced it to look beyond. And, they have taken the escape clause and said that they don't mind having a higher fiscal deficit at this point of time. What this does is, without increasing taxes, it enables them to have resources which they can use to spend on infrastructure. Hitherto, to balance to keep fiscal deficit low, the government always resorted to some form of taxation or cutting some form of other expenditure so that they could, keep fiscal deficit under control. For the first time, when you allow yourself to have a 9.5% fiscal deficit or 6.8% for the coming year, you're saying that you're okay sort of borrowing your way out, spending money through borrowing and spending it on infrastructure spending and hoping that the economy comes up without increasing taxes. So that was for me the first big message. The second big message was privatization was no longer a bad word. After I think Mr. Vajpayee's government, which actually had a specialized privatization or a disinvestment minister, you now have the government actually saying that they will privatize two public sector banks and an insurance company. This is the first time I'm hearing such a broad-based statement happening over the years. Similarly, the disinvestment target has been set at a very aggressive number for the following year, in the hope that they're able to push through some of these big ticket items, including LIC and so on and so forth, out into the market. And this would give them the necessary resources that they need to spend without raising taxes as such. Creating of a bad bank is something which has been talked about for a very long time. So what you effectively do out here is you remove the so-called stressed assets from your existing banks and move it into a specialized bad bank, which then looks to raise capital from international investors, from stress investors, to either try and turn around that or to try and normalize those accounts or restructure and sell those accounts. Effectively, what you get with the existing banks is a clean balance sheet, and so on and so forth, and their ability then to focus on growth going ahead. So I think the bad bank concept was again a very, very interesting concept. So all of this basically has been built on the premise that we are going to have a 14.4% nominal GDP growth, which in my view should not be very difficult to get at. Considering the fact that if you really look at it, if we had a 7.5 negative turning into a positive 0.7, so you're seeing a big delta swing in a sequential quarter of almost 8.5%. And then when you move in next year and you have virtually a zero base effect on the Q1, so having a 11% growth plus inflation of giving 14% should not really be a tall ask in my view as such. So I think these are a lot of investors have actually asked us that what would be the impact of the budget on your stocks. Frankly speaking, our stocks are constructed in a way and manner where we look at the impact that they have from changes in the industry level. But honestly speaking, if you ask me, there is no specific impact on any of our stock as far as this budget is concerned, except the fact that being a pro-business budget, it enables or sort of acts as a positive impetus from a sentiment perspective, from a demand creation perspective for all the companies in our portfolio. So, having said that, if I have to now talk about some of the risks or the so-called bear case that people are afraid of in this markets as such. So, one of the biggest risks that I see at the present moment, besides of course the COVID risk, but I do not regard COVID as big a risk right now, because when COVID struck us, it was an unknown animal. We did not know much about the infection. We did not know which medicines would work against the infection, how one should go about protecting oneself. All of that has changed now. So pretty much everywhere in the world, there is a standard template which enables us how to deal with COVID. So COVID can slow down the risk of your recovery or slow down the economy, but it cannot act as a unknown risk any longer. The new unknown risk, if you ask me, which most people are afraid of, and which most people are in the West and economists and everybody have talked about the fact that the amount of stimulus that has gone into the global economy uh, from the central banks of the world in the US and Europe could give rise to inflation going ahead, right? And which would mean that bond yields could start hardening, which means that the central banks could start looking at inflation with concern and look at reversing the interest rate cycle and so on and so forth. This could mean also from our perspective, it could essentially mean a reversal of liquidity flows. The kind of strong liquidity flows that markets have seen, it could mean that. That has two connotations. If you really look at it from a perspective of any company that you are invested in, and more so if you're a long-term investor. If you're a short-term trader, none of this actually matters as such. For you in the short term, all that matters is volatility. But if you're a long-term investor, the company that you look at, you essentially can lose money in two forms. One is there is a change of fundamentals that could happen of that company in terms of the business environment or competition or demand going down and so on and so forth. So there could be a change of fundamentals which could have an impact on the long, and that is more long term in the nature of impact on stock prices. Second is the derating of valuations. So, for example, when you have interest rates at, let's say, 5%, you might say 20p looks fair game. If you have 2%, then suddenly people start saying, what is that P ratio that you're ready to pay? But when the interest rates start going up, you could very well have a derating of valuations that happen. However, as I will explain in the next slide, to me, that is more of a short-term impact because you could see liquidity flows moving away from equities and stock prices correcting from a valuation perspective. So I will give you our view on what I think is with respect to some of these risks. So as far as hardening of bond yields are concerned, as of now, there is no indication of inflation going up in the US as such. It's because uh, people don't, all the consumption that is happening in the US is happening based on the money and handouts that have been handed over. And most people are essentially using that to meet their basic needs as such. So, and once again, like 2008, there has been, because asset prices have gone up, there has been a sort of disproportionate increase in income and well-being, with the rich having become richer thanks to the fact that they can own some of these assets, whether it is real estate, whether it is equities, and or even if it is cryptocurrencies and so on and so forth. They are making more money, and the broader population has not been able to make that much, which does not increase the broader population's spending propensity, which could actually cause inflation. So as of now in the US, you're not seeing any inflation take place, and easy money and low yields continue. And even the Fed has actually talked about the fact that if more stimulus is not given further, then the US economy might not recover faster. So I don't see inflation becoming a chronic problem, at least in the next 2 years. But then, this is the economy, and I don't envy the job of economists a lot in terms of getting things right. Now, having said that, even if that event were to happen, right? Let's assume that we don't get that right, and that event happens, and interest rates increase. What would be the impact of fundamentals? And so it's very well known that when interest rates start moving up, companies who have high debt or companies who have low return get impacted. For our companies and the type of companies that we invest, so if you look at our portfolio, the average ROC of our companies ex financials is 26%, which is a very, very handsome ROC. Our companies have an average of 66% operating cash flows to the EBITDA. okay, which means they generate substantial parts of the EBITDA as operating cash flow. The debt equity levels for our universe of companies is 0.36. And mind you, this is because we have, let's say, Bharti, which is a large telco with debt on it. But if you were to take that out, the debt equity is far much lower. Working capital cycle for all our companies on an average is about 45 days. So on all parameters on which businesses run, in terms of efficiency of use of capital, in terms of turnaround time as far as working capital is concerned, in terms of the debt equity ratio, all of them sort of fall in very nicely. So even if interest rates to go up, we don't see any change in the fundamentals of all our companies. Coming to the second and the more pertinent point which could happen for some of our companies, which is derating of valuations. So, for example, when we first bought a Deepak Nitrite in our portfolio, it used to trade at 8 times price to earnings multiple. Today it trades at 16 times forward price to earning multiples. In the middle, it was trading at 22 times and so on and so forth. Now, uh, price to earnings multiple is often a function of two things. One is what is the liquidity scenario in the market and what is the growth rate of the company. So if the liquidity were to turn, you could see a derating in terms of the P multiples. However, given the strong fundamentals that I talked to earlier, and the fact, and more importantly, that our companies are growing and our propensity to choose companies which are doubling their earnings every 4 years, even if there is a temporary derating, because the companies are growing at the pace of 18-19% per annum, the fundamentals will soon catch up and we will recover the price loss if that were to happen in the markets. And hence, I refer to the fact that if such an event were to happen, I don't believe it is going to happen immediately. But if it were to happen, the fact that we are in high growth companies would mean that our stock prices would come back faster from any correction that takes place. Also, the fact is that if you look at the the valuation, if you take the CNX 500, it trades at an average trailing 12-month P ratio of 44, while our stock of portfolio is trading at 27. And if you factor in the growth of some of our companies, which I will share ahead, it is even lower if I take 1 year ahead, because 27, when I talk to you from a trailing 12 factors in 1 quarter of virtually no performance and 1 quarter of half performance, which was Q2. So effectively, it looks inflated to that extent. But if I take it 1 year forward, it actually comes into its teens and so on and so forth, which is not unusual from a price perspective. Now, so that is in a nutshell my take on the state of the economy, uh, some of the positive factors that continue to drive us, and some of the risks and how our portfolio is positioned vis-a-vis those risks. Now, coming to our growth and momentum portfolio, which is our flagship product. As you would have seen, we've almost been now around for 9 years. This is our 10th year, and we are 1.5 months into this year. Uh, this year onwards, we have changed the way we report our numbers. So hitherto, if you remember, whenever we declared our numbers, it was always done on the basis of our model portfolio which we created, and there was a rationale for that, because clients would come in at different points of time, and our model portfolio was something which was the constant which was created over a period of time, and hence we were declaring numbers as per model portfolio. But as per SEBI mandate now, SEBI earlier gave you a choice to choose between different models in which you could report your portfolio. As per SEBI's latest mandate, all portfolios have to be reported on the basis of TWRR, or which is time-weighted return as such. So what this does effectively, time-weighted return, weighted returns does is, so if it basically, first, most importantly, these numbers are post all expenses and fees. The model portfolio numbers were pre-expenses and fees. Second, in this model of ours, if we hold cash in our portfolio, it acts as a disincentive to our returns. Because, so for example, just to give you a perspective, if we were doing a model portfolio computation and we were owning 95% invested and 5% cash, the return would show you 95% for the stocks and 5% whatever is the cash and where it was invested. In today's portfolio, even if the model portfolio by the way remains, if the new client who comes in, and as you know, traditionally we've had this approach of investing money for all new clients in a gradual manner. We've essentially always done it over the last 9 years in 3 tranches of 1/3, 1/3, 1/3, 1/3 on day one, 1/3 after 1 month, 1/3 after at the end of the second month. What happens is that in the intermittent period, if there is a lot of new clients who come in and we are only 1/3 invested and we are sitting a lot of cash, what will happen is while the old client will yet be 95% invested in the new client is only 1/3, but the excess cash that we are sitting on the new client at the console portfolio level will show lower returns because of the cash factored in. And as it said, it's a time-weighted return method which SEBI has mandated. So hence, what will typically happen also is in a bull market when things are running up, you will see that this number would always be lower than our model portfolio numbers, and we can share our model numbers also. But in a bear market, it also works in your favor, and so on and so forth. So that is one big difference in terms of the numbers, and this is now. So we went back and we changed all our numbers to reflect this new model. This model is also going to be very close to the number that you see in the statements that you receive, because your statements that you receive are net of costs and expenses, and so on and so forth. So as you can see, it's been 9 years since inception. Post-cost, we've done a 25% compounded return number. Last year, we did 33% compound for the year as such, vis-a-vis 17, which is almost 2 times the market. And this year, again, you're seeing a number of 8 and 10, but if you see a lot of clients who were there from last year onwards, your portfolio actually is up 10%, but this 8 on a console level shows because the new clients, just to share, in the last couple of months, we have more than doubled our size because we've had a lot of new clients who have entered. So hence, we've had a little higher proportion of cash at the console portfolio level. And hence you see that 8 and 10 in terms of the difference. Some of the big winners for us, and our approach has been to try and pick stocks which double every 4 years. And we also have a mid-cap bias in this portfolio. So some of the big winners for us have been stocks like Vaibhav Global, which has actually contributed to almost 20% of this return that you see. Vaibhav Global has actually gone all the way from 7,800 to 2,900, and it's sort of moved up 4x in this last 1 year, ended December. Granules, which has contributed another 20% to the portfolio. We've had Apollo Tricoat, which is 5%. Deepak Nitrite, 4.6%. 4.6%. These are attributions. But if you look at returns, they are actually far more, because even stocks like Deepak Nitrite have given you almost 3x your return in 1 year. Similarly with IOL Chemicals. And of course, Gujarat Gas, which is 2.7% attribution, which by the way, in the last 1.5 months, Gujarat Gas actually has contributed far higher. Even today, it was up almost 10, 11% and so on and so forth. So our mid caps has done extremely well for us, which is a testimony to our stock picking skills in the portfolio. All these companies have, while growing aggressively, are in a stage where they are now showing very, very strong return on capital numbers. They're showing very, very strong working capital management. and and they've become leaders in their respective field as such. On the other side, you will see that we had some laggards. Incidentally, for all our clients, you will probably only see the last one in your current portfolio. That's because Aster DM, which is a hospital company, was sold out right at the beginning of the year in February of last year, before the COVID struck. Axis Bank was one of our private sector bank holdings, which we sold out because of the NPA related issues. ITC is something we sold out because of our stop loss philosophy. It was cheap. We bought it around these prices where it is currently, but it went down all the way to 140, and we had to sell out before that. Suntech reality, while we made money in this stock, we had held this for 3-4 years, but it came off from its peak, and that's when we got out of it. As we were, in fact, before COVID, we got out in January last year. We got out of Suntech reality. So the only stock which is a laggard and which is yet in our portfolio has been Bharti Airtel. This is our model portfolio, which for all of you must have sort of seen these stocks in your monthly MIS statements. We have what we believe are the best 4 banks in India. 3 of them are, of course, very large banks when you talk about HDFC, ICICI, Kotak. And of course, Bandhan is a smaller bank, but it's one of the most well-run banks with a microfinance background and efficiently run. NBFCs, we've gone and chosen 2 of the best NBFCs, and the result is there in the price, where actually you're seeing the price of these stocks having completely recovered the entire drawdown that they faced, whether it's Bajaj Finserv or HDFC. Life insurance, we continue to own SBI Life because we think it's one of the cheapest life insurance companies, almost on par with HDFC Life in terms of size, but far cheaper as far as valuation is concerned. Chemicals, we own Deepak Nitrite again as of old. We have in pharmaceuticals we had IOL, Abbott, Granules, and JB. Abbott was a new addition which came in last month. IOL, while it shows here in the model portfolio, is on its way out. I mean, just between yesterday and today, we virtually got out of most of our IOL chemicals because the current quarter results were disappointing. The strong growth numbers that this company had shown over the last few years was starting to taper out. Shortage in ibuprofen was lesser, and ibuprofen prices, which were as high as $16, were now down to 13.5, and would remain sort of soft. So we were yet making 2x, 3x on our returns, and so we got out of IOL between yesterday and today. Granules we continue to own. JB Chemicals is now owned by KKR, and they declared some exemplary numbers during the quarter. So that's our pharmaceutical portfolio to you. In the agrochemical space, we used to own, if you remember, UPL earlier, which we sold out a month ago, and we bought into PI Industries. PI is an extremely well-run company. We used to own this in our portfolio many years ago. We made a re-entry into that stock recently. It's a company which gets premium valuations in the market. Gujarat Gas and Indraprasth, the gas utilities which we have talked to you about and presented to you in the past. HCL Technologies is another entrant that we added. We took a exposure to IT on a good reward basis. We found HCL to be the most interesting of the lot. For the infrastructure, we have ABB Power, we have APL Apollo, Apollo Tricoat, and GMM Pfaudler. These are the 4 stocks that we've been owning. All these businesses, unlike traditional infrastructure businesses, have very strong working capital cycles, have very market leadership in their products, and hence have great return on capital matrices, and so on and so forth. Polycab is something we've been holding and it continues to do well for us. Bharti, we have talked about it in our past presentation, and Web of Global, which has been our star performer. How did our portfolio perform? Very glad to share with you that in the December quarter, our company's operating profits grew at 32%. Our company's consolidated profits or net profits grew 39%. So as you can see, it sort of clearly meets the mandate of growth that we have set for companies which will sort of double earnings every 4 years, which translates into roughly around 19% CAGR. But our companies are growing at 2x that. And this is what I was referring to, that even if tomorrow markets were to temporarily derate, the earnings of these companies would mean that the stock price would move up and capture the previous price far faster as such. To us, growth is the best panacea to all short-term blips as far as market faces. Our financial portfolio, as you can see, also grew at 18% in terms of the earnings growth, with Bandhan Bank actually growing extremely well, but taking a one-off provision due to COVID, which saw its earnings degrew as such. But otherwise, the overall sector, our companies grew at 18%, which is again very well and meets the mandate. SBI, you are seeing a 40% degrowth again because of some provisioning, but if you see the premium growth, it's grown at 18%. And pretty much soon, I think SBI is going to be back on its earlier earnings growth path. The True Blue portfolio is just about a month old. We started off the True Blue portfolio, as you remember, and we had a presentation in December about it. The portfolio is about a month old, but we thought we will give you some flavor and some update on that. Very quickly, just to recap, this is a rules-based approach portfolio where we look at historical growth for companies in the last 2 years, where we look at consistency of return on capital, we look at consistency of operating cash flows being there, along with what that gives us typically is businesses with strong balance sheet, low volatility of performance, and unmatched management quality as such. In the True Blue portfolio, if I were to sort of talk to you about the earnings of our companies, as you can see, the operating profit of these companies grew 24%, which is higher than the mandate we have in terms of the growth cutoff that we set. The net profit grew at 49% for our group of companies, again far higher than the mandate that we have set as such. So it's a company of it's a portfolio of some very strong companies, some companies with whom you could sleep with. It has been my fervent belief that and that is why we arrived at this construct of such a portfolio. In the financials, as you can see, again it is Bandhan Bank and Bajaj Finance who sort of dampened the pitch out here. Bajaj Finance, as is well known, is because of the high provisioning that they took, but the stock has come back extremely strong after that. Bandhan, again because of one-off 1,000 crore provisioning that they took because of COVID. So that's our financial portfolio. The model portfolio, for those of you own this portfolio, can be seen comprises of the agrochemical sector. The agrochemical sector, as you are aware, as most people would be aware, is a sector which generates huge returns on fixed assets, has great working capital, this thing. So there we believe we have two of the finest agrochemical companies, Bayer Crop Science and PI Industries, in our portfolio. Again, in the banks, We have some of the finest banks like HDFC and Kotak, and of course Bandhan, electricals, Polycab. So you'll see there's a lot of interlap between some of the stocks that we own here and there. And that is because at the fundamental level, the stock picking does not really change. We look for the same qualitative parameters out there. The difference being, while in growth and momentum, we understand the business and say that this business has the potential to do this. So we identify some of these at a very early stage. In True Blue, these businesses have already demonstrated that potential over a period of time, and based on proof of delivery, we are investing. So in a sense, a lot of these stocks would first find their way into, so especially in the mid cap space, in the growth and momentum, and then move into the True Blue portfolio. So we have, if you see here, the weightages of sectors are different. So you see IT services we have 3 stocks here in the form of Mindtree, Wipro, and HCL Tech. In the form of NBFCs, we have Muthoot Finance and Bajaj Finance and SBI Cards, vis-a-vis a Bajaj FinServ that we had out there. Oil and gas, Gujarat Gas remains. Pharmaceuticals, as you can see, we have completely different names in the form of Ajanta, Alchem, and Aurobindo out here, and so also in chemicals. So there is, I would say, like a 35-40% interlap. Otherwise, it is fundamentally very, very different in its approach and style. So portfolio commenced on 13 Jan. During the time, the benchmark has given a 3.8%. Our portfolio has given 1.8. And the reason for that is that we, as you know, we staggered our investment into this whole model by investing in the same manner. So hence, since it's been only 1 month, we were, if I were to really look at it, we were hardly 50% invested for this return of 1.8%. So now we are almost 75% invested. Also, in this 1 month, the stocks which have delivered returns have mainly been the public sector banks and the cyclicals, which wouldn't fit into the True Blue portfolio mandate any which way, which focuses on high return on capital, high growth, high sustainable growth, mind you, and not just 1 quarter growth or 1 year growth. High sustainable growth, high sustainable return on capital, and high sustainable cash flows. So some of the top movers in the index rally have been Tata Motors, SBI, Adani Group. None of these would qualify on those parameters for them to be a part of True Blue. But they've done well in this short duration and hence have contributed to the jump in the BSE 200 during this point of time. So summarizing, our PMS has delivered a 645% return since its inception, which is a 25% CAGR number over 9 years and 1 month. It's got a 1100 basis points outperformance over this period. 1 crore invested on 1st January would now be worth 7.5 crores. We believe we have been one of the best performing PMSs for this duration. In fact, we are one of the few PMSs which has withstood so many years and the test of time and delivered consistency. That's from me. Thank you, and we could open the floor for questions.
Thanks, Nitin. I now invite attendees to ask their questions. You may use the Q&A box below. Nitin, let's start with the first question. Going into this earnings cycle, there was a belief that a lot of the earnings growth could be pent-up growth. After seeing 9 months of earnings, what's your take on this?
So yes, there was skepticism that there would be pent-up growth happening, and yes, I'm sure there was pent-up growth happening. But you see, the festival season took place in October and November, where you would have seen that impact. What about December? What about January? What about February, which continues? So in my view, yes, pent-up growth definitely, but somewhere the ease of liquidity, the fact that interest rates are so low, for me, and I'm sure for a lot of participants, I don't remember seeing these low interest rates on deposits and as well as on uh, loan products for I think couple of decades plus. In fact, more. I don't recollect seeing. I mean, when did you recollect a mortgage loan available at 6.8%? In fact, I think that has been one of the large movers besides stamp duty rate cuts and so on and so forth to cause real estate demand to be good as such. Not only that, tractor demand, agriculture has been strong. So while I do believe that there was pent up demand, but I think that pent up demand was built upon after that and has continued to remain strong and robust. GST collections are at 1.2, 1,20,000 crores, uh, which is phenomenal because they were not even there prior to getting into it. So I think uh, this growth has remained sustainable. And normally, my belief is that when a momentum like this starts, it sustains for itself. Also, one big factor which I was seeing is for the first time we have negative real interest rates. So today, if you were to actually put your money in a bank account or a savings account, you would actually earn negative returns, adjusting for inflation. This scenario always moves people away from financial savings to hard assets. Could be real estate, could be gold, could be other things. So I think so there is a disincentive for savings. So I think the impact of low interest rates cannot be sort of judged more or disregarded.
Right. Next question is in, for how long do you expect this bull run to continue?
I wish I had a clue. You know, how long? Do I expect foreigners to keep on investing in India? Is it going to be with the same velocity? I'm sorry, I have no idea because all I can tell you is that the economy seems to have reset itself. Liquidity is available in plenty, and as long as the economy continues to grow, corporates continue to deliver earnings, I think money chases growth. Look at it realistically, right? You might see this is never a one-way ride, right? When you invest in markets, you cannot invest in markets knowing what is going to happen in the next month or the next month or the next month. I think that is a very, very fallacious and stupid way to invest money into the markets. When you invest into markets or an asset class, you take a view of a horizon, you take a view of a distance. Now, if I do that, what do I see? I see the fact that the Indian economy has come back strongly. Interest rates are low. Liquidity is surplus all over the world. India seems to be, if it grows at 11.5% plus inflation, so now 14.5%, 15% next year, it's going to be among the fastest growing economies in the world. You're going to have a scenario where, and I've always seen that money chases growth. The government has sent out a pro-business message. So if that all prevails and happens, I see India growing, and India will grow, and money will come to India. Now there will be phases when, due to reasons where where the investors feel, well, I think the market is now temporarily overvalued, and that flow reduces, or some event takes place which makes them allocate to some other country vis-a-vis India, and so on and so forth. So there will be those intermittent trends where you could see Indian markets starting to sell off. But realistically, uh, even through all bull markets, we have had these 10-15% sort of corrections. And not once, not twice, not thrice, but innumerable amount of times in bull markets. If the fear is, are we going to get a March 20 correction or a very deep-rooted correction of 25-30% plus in the index, realistically, my belief is no to that answer. Will it happen in some stocks that you could get a 20% correction? The answer is yes. The idea is to be sitting through those to make money.
Right. The next question is in, if we are to invest one unit each in growth and momentum and True Blue. Over 5-year horizon, how would you compare the returns between the two products?
So when so as you can see that over an extended period of time, growth and momentum has returned 25%. Now, of course, it came on the back of markets which were very low at the beginning of the launch of the scheme. But if I were to believe that we are looking to invest in companies which are doubling every 4 years, we're talking of a 19% CAGR return. So I would think that 19% CAGR return would mean that we should get a similar, if not a better return from growth. And so let's say 20% CAGR. What our backtest numbers on True Blue have shown is that True Blue has delivered similar numbers to what growth and momentum has delivered. Growth and momentum had slightly better numbers, but True Blue has delivered numbers which are around that ballpark, nothing materially different. Because, like I said, you will see that there is a 40% overlap between the two portfolios in stocks. Also, what we do in growth and momentum is we go and try and find companies and understand the model and see in the future how this model is going to pan out and what kind of return. So we might have a company which has low return on capital today, but is generating high incremental return on capital, and we might invest that in growth and momentum. But in True Blue, we wait for the last 2 year data to tell us that this company has done this sustainably over the last 2 years for it to qualify for investments as such. So in that sense, it has already become a blue chip, and it's so we are investing in a bucket of blue chips out here. In this, we are investing in some blue chips and some emerging blue chips, and so on and so forth.
The next question is from Mr. Gokul Nathan. Given that some stocks have not matched the recent rally in hotel stocks or entertainment stocks, would you consider it as a value investment?
So, like I said, for us, the question is when we talk about value. So, first and foremost, for us, even if it means investing in value, value has to come with growth. We do not invest in anything just because they've fallen and become very cheap. We want growth. We want visibility of growth. So what that does for us is we might not buy some of these value stocks as contrarians at the bottom. We might buy these value stocks when we see the first signs of or early signs of turnaround happening out there. So we did own some entertainment company. In fact, we owned Inox Leisure in our portfolio going into the COVID crisis, which we got out because before it sort of broke, before COVID sort of erupted full-fledged out here, because we were apprehensive of after what we saw in Italy, of what could be the commensurate impact in India. So to answer your question, we would probably look at investing the moment we see growth coming back.
The next question is from Mr. Narendra Vemuri. Excellent performance and presentation. As you mentioned, a lot of new clients have been onboarded in late 2020. Are you planning to provide online access to your clients to access performance reports and portfolios?
So Narendra, we are working on it. As of now, we are not yet ready as such, but we have also, as you know, we have moved to a custodian has become mandatory. So we have now moving to the custodian. And as we are working on it, we are very sure within the next few months, we should be able to, or at least a quarter, start providing online access.
The next question is, why are bond yield rates falling?
So, because there is just too much of surplus liquidity. So if you look at bond yield rates, why are they falling? So typically there is too much of liquidity in the markets, right? So today, if you see corporates on the short end are able to borrow at rates. The other day I was reading Bajaj Finance borrowed at 3.8% in the short-term market. So there's just too much of liquidity and demand is not yet as strong. So that's one level why it is. Second is the fact that there is an expectation that inflation will come back at some stage, and there is a nervousness regarding that. And based on that, there is also a fear that interest rates will be hiked. When that typically happens, you normally see when interest rates get hiked, bond prices fall as such. So, in fact, in the US, bond yields have shown some initial signs of hardening. Not a lot. It's initial fear. So in India, I think we have not yet shown that because the liquidity surplus, credit demand is not yet as strong as such, and hence rates have actually been very low.
The next question is from Mr. Sandeep Bendre. Do we invest one unit every month as if it was an SIP?
You could. In fact, we have a few investors of ours who have been investing. Once they qualify for the minimum SEBI threshold of 50 lakhs, all incremental money is coming in installments. Some of them are investing over 6 months, some of them are investing over 3 months. So, but once you have a PMS account open and you have the initial 50 lakhs, you could invest in the form of SIP for the rest of the money.
Nitin, that was the last question. You can give your closing remarks.
So thank you, everyone. As usual, we thought we will give you a flavor of how we see things, what are the risks, preemptively talk about them, and how we are doing, what are we doing to address some of those risks, and also our portfolio. I hope this was useful. I hope to continue interacting with you, on a regular interval. Thank you again once more for your support and your time.